So good morning. How are you all? Good morning, everybody.
Good morning, sir.
Oh, you are there. I thought you were not there. So how is life? Fed up? Voice is the class fed up with the classes. Then just got up. Okay. So you are all coming to the campus? Hmm? The same mail is received by me also. So we are not sure. So but I heard from the other sections that you have a meeting with your PD. The IMF has a meeting with Bharat at 10 o'clock. So any member from IMF who has joined the meeting and joined the class after that? No.
No, sir, we don't have any member of IMF in this class.
So your class doesn't have anybody from anybody in the IMF?
No, sir.
Okay. No, yesterday I contacted Sabuni to find out, like initially, because after this class we'll have 2 more sessions. So I just told her that if it is offline, then I'll prefer to take all the sessions offline, remaining sessions. So Sabuni said she doesn't have any information. Then today we received the mail. Of course, the mail came from Delhi campus.
Yes, sir.
But first informations are with the students normally, so you don't have any information.
No, sir, the mail came directly.
That's all. And after that, you are sitting tight. You are not contacting your other friends.
No, sir, we are talking, but we are a lot of uncertainty right now.
Okay. Chalo, we'll be starting. So what all we are doing? Any question, confusion with that? You say, then we'll. Anybody? Can anybody tell me what all we are doing?
So we discussed translation exposure in the last class, and we need to discuss transaction exposure.
Okay. So we discussed translation exposure. We have discussed that economic exposure is divided into 2 parts. One is transaction, one is operating. So translation exposure, let me just revise once again, arises when a company has a subsidiary in a foreign country. So, and it arises basically when at the end of the year. So this is the home country, headquarter, and it has subsidiaries in say 3 different countries. Suppose we also discussed Hindustan Unilever, not in the Unilever. So it has a subsidiary in Japan, subsidiary in Germany, subsidiary in United States. So at the end of the year, and 3 subsidiaries has 3 different currencies, which is different from the currency of the head office. So at the end of the year, when the subsidiary prepares its consolidated financial statement, so at that time, you have to convert the assets and liabilities as well as incomes and expenses in the books of head office. So while doing so, there might be a risk. Why? The exchange rate fluctuations can increase or decrease the value of the assets and liabilities. So then you can have a risk. So if the value goes up, that is not risk. If the value, of course, goes down, that is a risk. And that is what is called translation risk. So which can occur only when you have a subsidiary in a foreign country. Translation risk is also known as accounting risk or translation exposure, popularly known as translation exposure or accounting exposure. If you do not have a subsidiary, then you do not, a subsidiary in a foreign country, you do not have this translation exposure. However, what we see, most of the companies in India, they have some subsidiary in a foreign country. So at the end of the year, when they prepare the consolidated balance sheet in the books of head office, so there is some kind of risk. So you will see that there is one, if you see the consolidated balance sheet of any company, you will see there is a separate heading written profit or gains or losses from gains and losses from translation of subsidiary assets due to exchange rate fluctuations. So there you can have a profit, you can have a loss, and we also discussed that if there is a profit, that profit is not available for distribution of dividend because it is a paper profit. Okay. So that was economic exposure. I told you of 2 kinds, transaction and operating. Transaction will be doing in detail. Operating exposure we also discussed. All firms will be, whether you, transaction exposure arises as soon as you enter into a transaction involving foreign currency. Like either you are an exporter, you will be receiving foreign currency, or you are an importer, you will be paying foreign currency, or you have borrowed money in the foreign market. So all the cases you have a transaction exposure. So if you do not enter into a transaction involving foreign currency, you don't have transaction exposure. Operating exposure on the other side, which affects all the firm. So then we discuss that if the exchange rate changes, so naturally India will be paying more money for importing crude oil. As a result, the cost of petroleum products in the domestic market will go up. And we took this example of the tea seller opposite to IFT Kolkata campus. So his transport cost will also go up. So it will affect him. And not only that, he will also be exposed to foreign competition because foreign goods will become cheaper in our country if our currency depreciates. And then we discussed different methods of translation exposure. Today we will be starting transaction exposure, and these are I told you, these are the 10 methods which we are going to discuss. Any question up to this?
No, sir. Sir, are you sharing any screen?
Till now, no, but now I will be. So these are the 10 methods which I told you that I will be doing, isn't it?
Yes, sir.
So we'll do 2 cases here. One will be from exporter's point of view, one will be from importer's point of view. Today, first one will be starting from an importer's point of view. So out of these 10 cases, I also told you that some of them are theoretical. So for example, risk shifting is a theoretical discussion. I'll discuss. Currency risk sharing is a numerical problem. Currency collar numerical problem. Cross hedging or surrogate hedging is a theoretical discussion. Exposure netting is a theoretical discussion. Forward market hedge is a numerical problem. Foreign currency option, numerical problem. Money market hedge, numerical problem. Future market hedge, numerical problem. And pricing decision is, of course, a theoretical discussion. So let us start. So managing transaction exposures. So though this slide I'll share, but I expect you to solve the problems with me. It will be easier for you to understand. Okay. So Interglobe Aviation Limited, which is basically Indigo, managing its euro payable exposure. So that is the case. So Interglobe Aviation Limited placed an order to buy 100 aircraft from Airbus Industries Limited. The payment will be made in installments, of which 500 million euros is payable 1 year from now. Okay. So we have to hedge the risk of 500 million euro. Okay. It has a payable of 500 million euro 1 year from now. A remaining amount is not given. So we are bothered with the amount which it has to pay, 500 million euro 1 year from now. You are also given the following information. Spot rate euro 1 is equal to rupees 70.95 and 70.98. What does it mean? Anybody? Spot rate euro 1 is equal to 70.95 and 70.98. What does it mean?
If we want to buy 1 euro, then we need to shell out 70.98. If we want to sell, we'll get 70.95.
Very good. 1 year forward rate euro 1 is equal to 74.43 and 74.50. What does it mean?
Same, so like if we want to buy it, we'll get it for 74.5. If we want to sell, 74.43.
If you want to buy what?
Euro.
When?
1 year from now.
1 year forward market. You enter into the contract today, huh? So 74. Similarly for future contract, but future contract along with it, there is brokerage also because it is an exchange traded contract. So forward is not an exchange traded contract, so there is no brokerage. But future there is a brokerage. So if you want to buy 1 year future contract, you have to pay 74.45, and 1 year if you sell 74.25. Not only brokerage, future there is a margin money. We discussed, if you remember, margin money means you have to deposit money with the future exchange. So then there is mark to market, all those things, and most of the cases we find future is settled in cash. Okay, so remaining part, when we will do future contract, we'll discuss. 1 year euro rate interest rate is 0.5% to 1%. What does it mean? 1 year euro interest rate is 0.5% to 1%. What does it mean?
If we borrow euro, then we need to pay the interest rate as 0.5 to 1%.
Not very clear. Come again.
So like for a transaction, if you want to borrow from a bank like in Europe, then the loan amount, like the amount for that, we need to pay around 0.5 to 1% interest.
Again, it is not clear. If you borrow, you have to pay 1% interest. If you deposit, you will get 1.5% interest. Is that clear?
Yes.
Again, this is like bid and ask. So when you borrow, you pay more money, more interest. When you lend, that is deposit, you get lesser interest. Is that clear? So it's not
Yes,
around 0.5 to 1. Yeah. Yes.
Yes, sir.
And any question?
No, sir.
Is this clear to everybody? Sure. See, future is an exchange traded contract. Brokerage, don't consider brokerage here, because brokerage you pay. Now don't consider, I told you that forward there can be a single rate plus brokerage, or there are two rates. But don't mix up this with future. Future, you enter into the contract through a broker, because you are not allowed to trade in a stock exchange without a broker. Okay, because brokers are members of a stock exchange, you have to trade through a broker. So the broker will charge brokerage. Okay, this is the first part. Second is future. Since it is an exchange traded contract, the future is more costly and more liquid. More liquid means if you want to buy at any point of time, you can buy. If you want to sell at any point of time, you can sell. Suppose I enter into a forward contract with you. So if I want to close the contract, that is, if I want to come out of the contract, I'll have to square up with you. Square up means close the contract with you. And for that, you must agree. If you don't agree, then I'll have to find somebody who will buy it from me. Future, it is not the case. When I buy from you, I don't know you. Even if there is a single trade, suppose I am the buyer, you are the seller. There's only one trade in the market, so that also means then also you there also you do not the buyer and seller, they do not know each other. Okay, so buyer is buying from the exchange, seller is selling to the exchange. At any point of time, if I want to close my contract, I can go to the exchange and sell it. So how do I close? If I buy, I have to sell. If I sell, I have to buy. So anybody can close the contract. So future contract is more liquid, but on the other hand, it is more costly. Forget about brokerage part. In a future contract, you have to pay margin money. So the money is blocked with the exchange for, in this particular case, where you are entering into a future contract for a period of 1 year. In this particular case, your margin money will be blocked throughout the period of 1 year. Okay. Now the question is, why somebody will enter into a contract which is more expensive or more costly? Absolutely simple. It is much more secured than the forward contract. Why? Because exchange is giving counterparty guarantee to both the parties. So since there is hardly any chance of default, that is why future contract is much more secure than the forward contract. And remember that profit and risk and return, these two always go together. Since forward contract is more risky, there is more profit. Future contract is less risky, so there is less profit. Yes, Ankit. Yes. Ultimately, it will become more costlier. So with price, when you, like, suppose you are paying a price of 74.43 per dollar, then you have to pay margin money, which will, now margin money you will get back, but the interest on margin money, that is your cost. Of course, no. Top of the cost means, of course, suppose you buy, what is the rate for future contract? 74.45. So suppose brokerage is 10 paisa. So it will be actually 74.55. Ultimately, it will become. Interest rate is fine. 1 year interest rate 0.51.
Yes, sir.
Similarly, 1 year interest rate on Indian rupees 6.5 to 7.5%. Somebody explain. One year Indian rupee interest rate is 6.5% to 7.5%. Somebody please explain.
Sir, if we borrow, we need to pay 7.5. If we deposit, we'll get 6.5 rupee. Okay. 1 year call option at a strike price of euro 1 is equal to 74.5 is trading at a premium of 1.5 rupees. Now, remember that there are many strike prices of call option, many strike prices of put option. So in this problem, only one is given. So how do you define this? 1 year call option at a strike price of euro 1 is equal to 74.5 is trading at a premium of 1.5. Anybody can explain?
we have done what is a call option, what is a put option. Right to buy. Right to buy at 74.5. No obligation. Yeah, by paying a premium of per euro. So for 500 million euro, he has to pay 500 into 1.5, that is 750 million euro. Okay? If he buys a call option. On the other hand, if he writes a call option, then he will be receiving 750 million euro, but he has the obligation to sell at 74.50. Okay? What about put option? Put options premium is, so 1 year put option at a strike price of euro 1 is equal to 72.5 is trading at a premium of 0.8. That means if you buy a put option at a price of 72.50, you have the right to sell 1 euro at 72.5. But for that, you have to pay a premium of 80 paisa per euro. And so 500 euro, 500 into 0.8, that is 400 million rupees. And if you sell one put option, if you sell one put option, then you will be getting 400 million rupees, but you have the obligation to buy. You have the obligation to buy at 72.50. Any question?
Sir, how is the premium calculated?
How is the premium calculated? Who is this?
Nikhil, sir.
Nikhil. Nikhil, have you heard about Fisher Black, Myron Scholes, Meton? No.
No, sir.
But you have heard about Black-Scholes option pricing model?
No, sir.
So this Fisher Black, he came out with a pricing model. So there are some problems. So it was, we call it Black's model. Then Fisher Black and Myron Scholes, they came together and came out with a Black model called Black-Scholes option pricing model. Okay. So once they came out with that, there was a problem with that. So Meton joined them. So they actually needed a rocket scientist, which was, you can say, so Meton joined them, and ultimately it was Black-Scholes Meton option pricing model. Why I am saying this? There are many other option pricing models. These three people, unfortunately, Fisher Black died. So Myron Scholes and Meton, they were awarded Nobel Prize for this option pricing model. If you take derivative, of course, we don't derive it in the class. If you take derivative, we will talk more about this option pricing model. Though there are many other option pricing models, so there is one binomial model, there is one, what do you call, jump theory, there are many things. Ultimately, it is the Black-Scholes option pricing model, which is used all over the world by everybody. Okay, so for pricing options. So premium, like I have told you, that there are two things. One is a value, one is a price. Okay, so premium is determined by market price, demand and supply. Okay, but it cannot come from any other place. So how do you arrive at that value? That is determined by option pricing model, Black-Scholes option pricing model. So Meton name is not there. You can watch a documentary on YouTube called $3 Trillion Bet. Or you can give a search about documentary on Black-Scholes. So there you will get the interview of Myron Scholes, because later on they also were involved in a hedge fund. Myron Scholes as well as Meton, they were all professors, professors in good business schools. So they left their job and joined a hedge fund called LTCM, long-term capital management, where they applied this lot of mathematical techniques in order to, trade. Anyway, that is also described there. That fund failed. That hedge fund failed. So in American Senate, it was discussed that is, if Nobel laureates cannot save a financial institution, then what will happen to the general public? Why I said so many things. So what I'm trying to say is, though they are Nobel laureates, but that doesn't mean whatever result is given by the model, that will always be correct. Make sense, Nikhil?
Yes, sir.
You
So
got
what all parameters are considered while getting at the premium, like apart from demand and supply?
one is a spot price, you know that. Today's price.
Yes, sir.
So if I open the, so this is the spot price. Okay.
Yes, sir.
This is the strike price. That also I have explained to you.
Yes, sir.
Okay. Yes or no?
Yes, sir.
So if it is a currency, you have two interest rates. So one is an interest rate. If it is a stock, there is only one interest rate. If it is a currency, it has two interest rates. We take the differential. Okay.
Okay, sir.
Time to maturity. Okay.
Okay, sir. Yes, sir.
Most important thing is volatility. What is volatility?
Like how volatile the rupee is, like how often it fluctuates.
So what is the probability, how the market is fluctuating from its average?
Yes, sir.
How do you measure that? How do you
So
measure?
variance.
Absolutely correct. Variance or variance.
Yeah.
Or
Variance with the
variance.
mean average. Yeah.
So variance is of course a. However, there is a small problem. When Black-Scholes, they came out with this model, so they used normal variance or standard deviation, whatever name you give. If I ask you, section D, now there are 52 students attending at least logged in. So if I ask you to calculate the age of 52 students, mean age of 52 students, very simple, you can do that. If I ask you to calculate the standard deviation of these 52 students, that also you can do that, but Nikhil's age does not depend upon Ankit's age, or Ankit's age does not depend upon Karan's age. Okay, is it clear?
Yes, sir.
So one's age is unconditional to another's age. But if I say today's return depends upon yesterday's return, or today's stock price depends upon yesterday's stock price. So this volatility which you are calculating, it becomes conditional volatility. So it took long time. So there was one person called Angel, who is also a Nobel laureate. He came out with this same calculation of standard deviation only, but conditional standard deviation. So there is something called ARCH, ARCH, auto-regressive conditional heteroscedasticity. Heteroscedasticity means standard deviation. So he came out with this particular model which measures conditional standard deviation called ARCH, ARCH, auto-regressive conditional heteroscedasticity. So after that, there are a lot of development in this ARCH family of models. So there are GARCH, generalized autoregressive conditional heteroscedasticity, eGARCH, exponential generalized autoregressive conditional heteroscedasticity. Then there are mGARCH, tGARCH, etc., etc. Both NSE and BSE use eGARCH for measuring volatility. So the option derives its value from volatility. An interesting part is nobody likes volatility, but everybody makes profit out of volatility. Okay, so it's an interesting topic. Normally, we have a separate chapter on volatility, discuss volatility for option pricing. So for the time being, you know this. That's all. We have talked a lot. Whatever I have told you, if you take derivative, I will tell you many things apart from this. Proceed further.
Yes, sir.
So these are the information given. On the basis of that, similarly put option I have experience. On the basis of that, you have to calculate the following. First of all, what is the hedge value of Interglobe Aviation Limited payable using? Here we have only the mathematical ones. Hedge value of Interglobe Aviation Limited is payable using the forward market hedge and money market hedge. So there are two. One is a forward, one is a money market. What is the hedge value of Interglobe Aviation Limited payable using future contract? That is also the prices are given. What alternatives are available to Interglobe Aviation Limited to use currency option to hedge its payable? So one is option. So option you have two. One is a call option, one is a put option. And which option hedging strategy would you recommend? At what exchange rate the cost of option is just equal to the cost of forward market hedge? At this stage, we will discuss why option is, what are the advantages of option and disadvantages of option with respect to forward contract. How can Interglobe Aviation Limited construct a currency collar? Another name of currency collar is range forward. So assuming a neutral zone of 68 to 74 per euro and a base rate of 71 rupees per euro, show in detail how the two companies can share the risk. So this is a risk sharing by two companies. So that also we'll do in detail. Also show the effects if the spot rate after 1 year move beyond the upper and lower boundary of the neutral zone, etc., etc. Which of the hedging alternatives analyzed above would you recommend to Interglobe Aviation Limited? So after discussing, you have to recommend. Okay. Any question up to this, or we will start discussing this method. The first one which I will discuss is exposure netting and natural hedging. Okay. The first one to discuss is exposure netting or natural hedging. Any question? Do you have any idea? Any question with the problem?
No, sir.
Why we are studying this hedging? The managing of risk is called hedging. Why we are studying this? Why we have to hedge your risk? Because I have a payable in another currency, and I know there can be exchange rate fluctuation. Similarly, instead of payable, if I have a receivable in another currency, then also I need to hedge my risk. Why? I repeat, why? Because here I am thinking that my currency can depreciate. Similarly, when I have a receivable, my fear will be if my currency appreciates. So today $1 is equal to 70, 1 euro is equal to how much? 1 euro is equal to 70.98 and 1 year forward is 74.50. So I estimate that after 1 year the prices can go up, my currency can depreciate. That is why I am entering into I'm thinking of hedging my risk. Similarly, if I estimate that my currency will appreciate, so in case of receivable, I will also have to hedge my risk. Yes or no? My next.
Yes, sir.
But consider a situation where you have a receivable as well as payable. So why Interglobe Aviation Limited has a payable? Because it is buying aircraft for which it has to make the payment. Suppose you consider a situation where Interglobe Aviation Limited, like it is buying new aircrafts, it is disposing of old aircrafts. So when it is disposing of old aircraft, in fact, Indigo operates in a different model, sale and lease back. Many airline industries operate sale and lease back. Suppose Indigo is buying new aircrafts and at the same time disposing of old aircraft. So they are, because aircraft life is quite long, but normally Indigo does not use aircraft which is more than 8 years old. Average age is maximum 8 years. Okay. So suppose Indigo is buying new aircrafts and disposing of old aircrafts. So the company which is, or the airline company which is buying the old aircrafts of Indigo, suppose it is also paying euro, and Indigo will be receiving 500 million euro. So on one side, 1 year from now, on one side, Indigo has a receivable of 500 million euro, and on the other side, Indigo has a payable of 500 million euro. Okay, so what will happen? If you have only payable, you have to hedge your risk. If you have only receivable, you have to hedge your risk. But if you have a receivable and payable, whatever you receive, that will be utilized to make the payment to Airbus Industries Limited. So receivable will set off against payable. That is, whatever you suppose you are buying from Airbus Industries Limited and you are selling this to France Airlines or say Lufthansa, German Airlines. So German Airlines, Lufthansa is paying Indigo 500 million euro. So whatever it receives from Lufthansa, 500 million euro, that will be transferred, simply paid to Airbus Industries Limited. Does it make sense? Yes or no?
Yes, sir.
So what is called exposure netting or natural hedging? When you have a receivable and payable of the same currency of same maturity. That is also what is important. When you have a receivable and payable of same currency of same maturity, then they are automatically hedged. I repeat, they are automatically hedged. So it is called natural hedging or exposure netting. I repeat, when you have a receivable and payable of same currency and same maturity, so your receivable can be utilized to pay the payables. So then it is called natural hedging, also called exposure netting. Any question on this? Anybody? Yes. Suppose it is not. You have a receivable of 500 million euro, you have a payable of 500 million euro, and you have a receivable of 450 million euro. Then what do? You can go for natural hedging for 450 million euro. Remaining 50 million euro, naturally you have to hedge separately. Got it? And maturity must be same.
So in this case, there's no
Yes, sir.
the currency never come into hands of the interglobe.
Suppose,
Right?
see, one currency on one side it cannot depreciate, on other side it cannot appreciate. So either it will depreciate or it will appreciate. Okay. Now,
Yes.
the point is, whatever, if you have a receivable, suppose you hedge your risk and the currency depreciates. So you lose money actually, because if you wouldn't have hedged, you would have gained money. Similarly, if you import, if you have a payable, then if the currency depreciates, you gain. So one side you have gain, other side you have loss, automatically it will be adjusted. You cannot have gain and loss both on the same time. Only thing is hedging has a cost. Okay, so naturally your profit or loss, whatever it is, that will be offset. Got it? Yes or no?
Yes, sir.
Any other question on this? Consider this case. Remember this problem?
Yes, sir.
So suppose this company, which has a subsidiary in Japan, company has a receivable, but a Japanese subsidiary has a receivable in Australian dollar, and it has a payable in Brazilian real. It has a receivable in, why it has a receivable? It has exported something to Australia, this subsidiary, for which it will receive Australian dollar, and it has imported something from Brazil, for which it has a payable in Brazilian real. What about this one? This subsidiary, it has a receivable in Brazilian real and payable in Swiss franc. What about this one?
Receivable in Swiss franc, payable in Australian dollar.
So it has a receivable in Swiss franc and payable in Australian dollar. Huh?
Yes, sir.
So consider individual company wise. This kind of what I'm telling you, this kind of thing is possible only in case of a multinational. So consider the Japanese subsidiary. It has receivable in one currency, payable in another currency. If it is a standalone company, it has to hedge its risk of Australian dollar. It has to hedge its risk of Brazilian real. So it has to hedge its receivable. It has to hedge its payable. Both the cases, it has a cost. Okay. Similarly for these two companies. However, this subsidiary may not know what are the receivables of payables of subsidiary in Germany or subsidiary in United States. But head office in UK, it knows as a, because all these multinationals, many of them have a centralized cash management. Okay. So one of the advantage of centralized cash management, or of course, the head office will definitely know what are the receivables and payables in different subsidiaries. So assuming the amounts are same. So instead of hedging individually where each of them will have a cost, so this receivable of Australian dollar can be utilized to pay the payable of Australian dollar in here. I repeat, this receivable of Australian dollar, that is receivables of Japan can be utilized to pay the payables of United States. Similarly, receivables of Germany can be utilized to pay the payables of Japan. And receivables of United States can be utilized to pay the payables of Germany. This is also called natural hedging or exposure netting, but this is in a bigger scale. That is in a possible. This thing is possible only in case of a multinational. Does it make sense?
Yes, sir. Sir, like the hedging will be done by the headquarters.
Of course. See, that does not mean Japan is giving money. So they will be definitely how much, because these two amounts may not be same. The value of Australian dollar, total value of Australian dollar receivable, total value of Brazilian real payable may not be the same. So accordingly, you have to adjust and hedge the risk. Got my point?
Yes, sir.
No. Hedging will be done. So ultimately, suppose there is a net amount payable by one subsidiary to another subsidiary, that will be paid through head office.
Yes, sir.
Okay. It's not that everybody will owe to others. So it will be netted off in a common currency and accordingly that amount will be paid. So this is also called exposure netting or natural hedging, but that is possible only in case of multinational. So we have done natural hedging or exposure netting of two kinds. One is a standalone company where you have a receivable and payable of the same currency of the same amount, and the other is multinational where different units have different receivables and payables, and the head office matches different receivables and payables, and the total is done. Hedging is done by for all the subsidiaries. Make sense? Any question, confusion?
So I have one doubt.
Sure.
Suppose like hypothetically, this thing is like that. Suppose we get an aggregator. How is that makes like sense, right? The aggregator will do natural hedging on behalf of these multinationals. Even small participants or other non-multinational can also take benefit of natural hedging, right, sir?
What you mean to say, suppose there is one company in Germany, one in Japan, one in United States. They do not
same company. Yeah. So it will take account of all the receivables.
You mean to say they are subsidiaries or different?
No. That is a third party. What I meant is an aggregator.
So suppose, let me tell you. So this is one company. Suppose this is Mitsubishi in Japan. This is Bosch in Germany, and suppose, or Siemens or Bosch in Germany, and suppose it is Microsoft in United States. Okay, so these three companies are not related, so all of them go to a third party and they do the hedging. That is what you are talking about.
Yes, exactly.
Possible, but he will definitely charge to others, everybody.
Yes, some amount.
If
But they will have this hedging, right? So natural hedging. They don't have the currency risk, right? In that case.
no, this company has currency hedging. Now you have a, instead of this headquarter, you have a third party who is utilizing this to pay this, and to pay this you are utilizing this. Now suppose if the value of this to same in all the places, then fine, but normally value will not be the same. Forget about that value. Now the mediator who is doing this, theoretically of course it is possible, mediator who is doing this, he is going to charge to Japan subsidiary, to Germany, to United States. So there is a cost. So the Japan company, that is Mitsubishi, will check whether that is profitable, or in a Japanese bank, if you hedge your receivable and hedge your payable, that is profitable, and accordingly they can do what you are saying. Hypothetically, that is possible to do. Hypothetically, that is possible to do.
Got it.
You have to find somebody. Okay? Anybody?
Yes.
Proceed. So we have done we have done exposure netting. Next one is cross hedging or surrogate hedging. Do you remember when I showed you the NSE that 4 currencies are trading in the future market? One is US dollar, one is UK pound, one is euro, and one is Japanese yen. Yes or no?
Yes, sir.
Yes, sir.
Suppose you are this Indigo, instead of this is euro. Suppose you are trading with a country where the currency is, say, Swiss franc. You are importing something from Switzerland, for which you have to pay Swiss franc. Now, hedging on Swiss franc is not available. Future contract on Swiss franc is not available. So what do? Of course, in a forward contract, you can trade anything. The reason being, it's a bilateral contract. Suppose you want to hedge your risk through future contract, and you find that hedging on future contract or future contract on Swiss franc is not available in India. What do? So you have to find out a currency which is positively correlated with Swiss franc, and euro is positively correlated to Swiss franc, because euro and eurozone and Swiss franc, they have a lot of trades among themselves. So you find that if euro goes up, Swiss franc also goes up. If euro goes down, Swiss franc also goes down against rupee. So since hedging on Swiss franc is not available, you hedge your risk with euro. This is what is called cross hedging or surrogate hedging. I'll give you another example where it will be easier for you to understand better. Consider Indigo buying ATF, aviation turbine fuel. Now, aviation turbine fuel is manufactured from crude oil. If the price of crude oil in the international market goes up, price of ATF will also go up. Now, future contract on aviation turbine fuel is available, but earlier it was not. So what do? You know one thing, that as an airline company, you know one thing, that if the price of crude oil goes up, the price of ATF will also go up. So since future contract on ATF is not available, but future contract on crude oil is available, so you hedge your risk on crude oil. This is what is called cross hedging or surrogate hedging. So when you don't have the hedging alternative on the product where, or the currency or which you are dealing in, so you hedge your risk with the help of another product or currency which is positively correlated with this particular product or currency. This is what is called cross hedging or surrogate hedging. Any question? Anybody?
So can you please explain it once again?
See, you want to hedge you are an airline company, you want to buy crude ATF, aviation turbine fuel. Okay, you go to the market, you see that in the commodity market, you see that there is no future contract on ATF. What do? You don't hedge. So if you don't hedge, you might suffer more risk, more losses. So what do? You find a commodity which is positively correlated with
ATF.
ATF. What is that? Crude oil. Because ATF is a byproduct of crude oil. So if the price of crude goes up, the price of ATF will also go up. So you are hedging your risk on another product which is positively correlated with this particular product. So this is called cross hedging or surrogate hedging. Make sense? Yes or no? Huh? Still have some doubts? No answer? What do you understand? Ankit, so there?
So one doubt, sir.
Sure.
So two companies, right? We can so one two companies in different country. So in that case, right?
Why
Let's
two companies are coming into the picture? One company, surrogate hedging, one company. Indigo wants to buy ATF, goes to the market, NSE, no future contract on ATF. Okay, what do? But future contract on crude is available. So you buy future contract on crude. So if crude prices goes up, ATF price will also go up. So if ATF prices goes up, you will suffer a loss. But if you enter into a future contract, if crude prices goes up, naturally you make a profit. So this profit will be utilized to compensate the loss in ATF price. Got it?
So this correlation, right? Is there any
Has to be
function?
positive correlation. Has to be positive correlation. Otherwise not. See, it may not have a perfect positive correlation, but has to be positively correlated. See, if the crude prices goes up by 10%, it is possible that ATF prices does not go up by exactly 10%, but one thing is clear, if crude goes up, ATF will also go up. Yes or no?
Yes, sir. Sir, am I audible?
Sure.
Sir, sorry, sir. My laptop was malfunctioning, so I had to join by phone.
Yeah, sure.
It was clear. Sir, like cross hedging is basically you will indirectly hedge the product, not directly, right?
With another, huh?
Okay, sir.
Any other question? Why we are hedging this risk? Interglobe Aviation Limited is an Indian company. It has to, whose currency is INR, but it has to pay euro. Yes or no? I repeat, Interglobe Aviation Limited is an Indian company. Its receivables, everything is in INR, but it has to pay euro. So that is why there is a risk. Why there is a risk? The price can change. Okay. So suppose Interglobe Aviation Limited tells Airbus Industries Limited, suppose that, see, I am the largest buyer of Airbus in the world. Indigo is for your information, Indigo is the largest buyer of Airbus in the world, huh? Because Indigo uses only Airbus. Recently, they bought some turboprop Bombardier, but otherwise, Indigo uses only Airbus. Until now, only A320. Recently, for long flight, they are placed some order of A321, but otherwise they use only Airbus. And one of the rare case, because other airlines, they have a combination of Boeing as well as Airbus. Now, suppose Indigo says, I am the largest buyer of Airbus. So if you want to supply, you have to receive the payment in Indian rupee. Or I'll make the payment in Indian rupee. If you don't accept, I'll go to Boeing. Very rare case, but suppose Indigo says that I want to pay you in Indian rupee, and if you do not accept, I'll go to Boeing. Airbus thinks that it will lose such a big customer, so it accepts Indian rupee. Possible? Yes or no? Very rare situation. Between Indian rupee, it is very difficult, but if it is between two buyer and seller is suppose dollar and euro, it is possible. Okay, but for the time being, let us assume that Indigo manages to pay in INR. Okay, whatever is the amount. Will there be any exchange rate risk?
Yes, sir, it will be there.
Huh?
So they will have a risk, right? If dollar,
Who?
Indigo, sorry, the Boeing, sorry, Airbus will have the risk.
So risk is transferred from Indigo to Boeing, Airbus. I
Absolutely.
repeat, Indigo manages to pay in Indian rupee. So Airbus now, instead of receiving euro, they will be receiving Indian rupee, which is not their currency. That will be that is Indigo's currency. So they will have to manage their INR receivable. But we are doing the risk management for Indigo. So suppose Indigo manages to pay in its own currency, so risk is transferred from Indigo to Airbus. This is what is called risk shifting. Any question? So that depends upon your negotiating power. And of course, your currency. So Indian rupee is not that much acceptable in the world. Okay, so if in the practical case, if Indigo says this to Airbus, Airbus will say you are most welcome. You can go to Boeing. Knowing fully well, Boeing will also not accept Indian rupee. Got my point? Yes or no? But what I'm trying to say is, if you can manage to pay in your own currency, then there is no exchange rate risk. Is that clear to everybody?
Yes, sir.
So that is what is called risk shifting.
So, but for that we need to have power of our currency as well as the
Not
supply.
only negotiating power of your how much you can negotiate, but the strength of your currency. Whether it is accepted everywhere or not. So had it been an US company, and US company can enter into a contract with Airbus that okay, I can, if you want to supply me, you have to accept US dollar, not euro. Got it? Huh?
Yes, sir.
Any question? Any question? So risk shifting is done. So till now we have done 3: exposure netting, cross hedging, risk shifting. Okay. So let me start the forward. Once we do forward contract, then this pricing decision is also theoretical, but let me do the forward contract first. So if I do the forward contract, what is the thing? Interglobe Aviation Limited has a payable of 500 million euro. So what is a forward contract? You enter into the contract today. Delivery of goods and payment for goods will take place on a future date. So, but forward, there is a different rate. This is the forward rate. Can you see the forward rate? So Indigo will enter into a forward contract to buy 500 million euro at a price of at a price of
74.50.
74.50. Is that clear? So see,
Yes, sir.
Interglobe Aviation Limited has a payable of 500 million euro 1 year from now. So 1 year forward rate is 74.43, 74.50. That means if you want to buy, you have to pay 74.50. If you sell, it will be 74.43. So therefore, to hedge the risk of euro payables, IGAL has to buy 500 million euro at a price of euro 1 is equal to 74.5. I repeat, IGAL has to buy 500 million euro at a price of euro 1 is equal to 74.5. So how much is the total amount payable after 1 year? After 1 year, not now. After 1 year, 500 into 74.5, that is 37,250 million. So after 1 year, Indigo will pay 37,250 million rupees, and in return it will get 500 million euro, which it will pay to Airbus Industries Limited. Any question? But remember, this forward contract, it is not entering into with Airbus. It is entering into with a bank.
So one thing is that the purpose of this is uncertainty is reduced, right? They can manage their funds.
Absolutely, uncertainty is reduced. There is no uncertainty.
Got
So
it.
after 1 year, your forward rate can be, your spot rate can be, when you are actually making the payment, it can be instead of 74.50, it can be 72 also. So that is the loss. But here our purpose is to, it can become 76 also. There will be a huge loss. If it is 72, the Indigo is losing profit. But if it is 76, Indigo is suffering a loss. Our purpose is to make sure that we don't suffer a loss. Okay? Yes or no? Here. Is that okay?
Yes, sir.
Yes, sir.
Okay, just another thing. So why you are entering into the forward contract? Because you know why you are entering into the forward contract, because you know that in future rate can be different. Future rate can be. Now, when you are bidding for a contract, so when you are don't consider that Indigo buys only from Airbus Industries Limited. Okay. Suppose there are many supplier of aircrafts. Indigo buys from whoever gives a better rate. Indigo will buy from them. Suppose Indigo calculates, say for example, suppose Indigo calculate its price will be, we sell its. Suppose Indigo calculates its rate is, say, suppose into 74.5. Suppose Indigo thinks, whatever, I'm talking about INR term. Suppose Indigo calculates how much money it can pay for the aircrafts. Though it is the installment, suppose Indigo thinks it can maximum pay 37,250 million rupees for the aircrafts. Why? How it calculates? Now you have done in your investment decision, that is net present value IRR. So if you pay 37,250 rupees, that is the maximum amount which you can pay, where your net present value will be positive. Otherwise, if you pay less than this, if you pay more than this, your net present value will be negative. Okay, I repeat. How you arrive at 37,250? You have used your net present value technique. There you have calculated what will be your possible cash flows from this, and you have seen that if you pay maximum 30, you can pay maximum 37,250. Otherwise, if you pay more than this, then there will be a loss. Okay. Now, suppose today if you say that I can pay you maximum 37,250 rupees, they will not accept. They said how much money you can pay in dollar. So Indigo knows that if after this, if there is a hedging and other things, so it will suffer a loss. So it bids on the basis of the forward rate. It bids on the basis of forward rate. When forward rate is available, you know that the future spot rate will be like this. I repeat, when the forward rate is available, the future spot rate will be like this. So you bid on the basis of what is the forward rate? 74.50. So this you divide by 74.5. So comes to 500 million. So you calculate and say 500 million. Or in other words, suppose Suppose Indigo calculates 500. Suppose 500, 37,250 is the A calculation. What do you call? Indigo says, just 1 minute. 500 into, what was the spot rate? What was the spot rate? 70.98. Okay. Suppose 500 into 70.98. Indigo calculates that 35,490 is the maximum amount it can pay. Indigo calculated 35,490 is the maximum amount. So multiplied by, if you divide it by 70.98, it becomes 500 million. So Indigo thinks that if I bid for 500 million, in the future I'll have to pay a higher price to buy 500 million. So it will not be profitable. I repeat, Indigo calculates on the basis of net present value IRR with those techniques. Indigo calculates the maximum amount in INR it can pay is 35,490. So if it pays 35,490, then it is profitable, otherwise not. Along with that, Indigo also calculates that if I bid for 35,490, then total amount, then at today's rate 70.98, it is equal to 500 million. But if I bid for 500 million euro, I'll have to hedge the risk. So ultimately I'll end up paying more money total, because hedging has a cost. So Indigo says I will pay you, but the offered price is on the basis of forward rate divided by 74.5. So Indigo says I can pay maximum 476.38 million euro. Why Indigo does it? Because Indigo knows future the price can be this, so I won't have to hedge. Or even if I hedge, my risk is less. I repeat, my risk is less. It is taken care of. So Indigo bids on the basis of forward rate. Okay. This is what is called pricing decision. When you bid on the basis of forward rate, taking the future losses into account, so it is called pricing decision. Of course, Airbus may not accept a lower price. That is there. So pricing decision is basically you take the future possible exchange rate into account, and accordingly you bid on the basis of this forward rate which will take care of your exchange rate, possible exchange rate losses. Any question? Since the total amount is less, this thing, what do you call it? Airbus may not accept that. That's a different issue. Concept clear? Concept clear? Anybody?
So the previous example, right? You told hedging in the oil or this oil contract, right? Similar thing for oil, right? That was the second cross hedging. Okay.
So this is what is called pricing decision. Any question? Clear? So pricing decision is done. Next one will go for money market hedge, because here if you see the second one along with the forward market hedge, we have a money market hedge. So what is a money market? Why I have a problem in the cross hedging or in the exposure netting or natural hedging? We have seen that we have a receivable and payable of an equal amount. In this particular problem, we have a payable only. If you want to create a receivable of 500 million euro, what do you do? What do you need to do? If you want to create a 500 million receivable of 500 million euro, how much money you need to deposit today? How much euro you need to deposit today in order to get 500 million euro 1 year from now? I repeat, how much euro you need to deposit today in order to get 500 million euro 1 year from now? Anybody? Yeah.
So 500 into 70.95.
Why?
That
Now,
amount
first
we
of
need
all,
to say.
first of all, you tell me how much euro you have to deposit today in order to get 500 million euro after 1 year. Got my point? Why 0.5? 0.005. 0.5%. So IGL can also use money market hedge. It has to deposit an amount of euro today at the rate of 0.5%. Why? Because if I deposit euro, I'll be getting 0.5% interest. That is clear to everybody. If I deposit euro today, I'll receive an interest rate of 0.5%. So how much euro I should deposit today? I should deposit 500 divided by 1.005 at the rate of 0.5%. That is 497.5124 million euro today in order to get 500 million euro after 1 year. So if I can do that, if I can deposit 497.5124 million euro today, I'll get an interest of 0.5% per annum. So which will become 500 million euro 1 year from now. So if I have 500 million euro 1 year from now, my deposit that will be utilized to repay the company, that is Airbus. Any question up to this point? If I deposit this amount of euro today, it will become 500 million euro after 1 year, which will be utilized to repay Airbus. Any question up to this point?
No, sir.
Where do I get this 497.5124 million euro? I have to buy.
In spot market.
What will be the rate?
70.98.
70.98.
So if I want to buy that euro in the spot market, I'll have to pay 70.98. So 497.5124 into 70.98. So 35,313.43 million rupees. Okay? Yes or no? If I want to buy this amount of euro, today I need 35,313.43 million. Where do I get this? I'll have to borrow. Huh?
Yes, sir. We need to borrow.
What will be the rate of interest?
7.5.
7.5%. Why? Because Indian rupee, if you borrow, you'll get 7.5%. If you deposit, you'll get 6.5%. So if you borrow, you'll have to pay 7.5%. So together, the principal amount on interest will become how much? 35,313.43 into 1.075. So 37,961.94 million. So ultimately, after 1 year, you have to repay 37,961.94 million. So what I am doing is basically, I have a payable of euro, which I am converting into rupee payable. Why? The euro payable, which I'll have to pay to Airbus Industries Limited, for that I have made a deposit. How I have made a deposit? I bought the euro today by borrowing in Indian rupee. So when I bought the euro today, I did not buy 500 million. Why? Because I know if I buy the euro, I'm not going to keep them in my cash box. I'll deposit them in the bank where I'll be getting 0.5% interest. So since I'll be getting 0.5% interest, I have to buy 497.5124 million euro today, which I can deposit at the rate of 0.5%. So it will become 500 million euro after 1 year. Okay. However, to buy this 497.5124 million euro today, I need at today's rate, I need at the 35,313.43 million. Now, I don't have this money. Even if I have this money, it has an opportunity cost. What is the opportunity cost? 7.5% is the borrowing rate. So, I'll be borrowing this money at the rate of 7.5%. So, I'll have to repay 37,961.94 million. Now, how I am hedging this risk? Basically, my problem was exchange rate fluctuation. Even if the exchange rate fluctuates after 1 year, I will be still paying 37,961.94 million rupees to the bank with interest. So its euro deposit will become 500 million after 1 year, which will be utilized to pay the Airbus Industries Limited. So therefore, hedge value of IGL using money market hedge is this much. Any question?
No, sir.
So basically, I am converting my euro payable to INR payable. I repeat, I'm converting my euro payable to INR payable. Make sense?
Yes, sir.
So this is similar to forward market. You remember you have done. We have done what do you call covered interest arbitrage. It is like that. So this money market hedge is similar to forward market hedge. When I similar to means absolutely similar to forward market hedge. So when you have to hedge and when you have a choice between money market hedge and forward market hedge, will theoretically the value of both should be same, but otherwise what we will do is we'll compare both the rates and accordingly we will take a decision which one is cheaper. We'll go for that. Any question? Money market hedge, any question?
No, sir.
So what all we have done? We have also done forward market hedge. We have also done money market hedge. So next one will be foreign currency future market hedge. Okay. So let's see what is given. So what is future market hedge? This is the future rate given. Future is different from forward rate, of course. So you have to buy a future contract. So what will be the price you will be paying? If you buy a future contract, what will be the price you will be paying?
74.45
plus broker charges.
Right. So in case of a future contract, there is a brokerage because it's an exchange traded contract. Forward is a bilateral contract, so there is no brokerage. But future is an exchange traded contract. There is a brokerage. So you have to pay brokerage. Not only brokerage, so future is also you need to keep margin money. If you remember, margin money, mark to market, these all we have done when we discussed future contract. I repeat. So future contract, you have to not only pay the price and brokerage, you also have to pay margin money. So when you pay margin money, naturally what happens? I repeat, your cost of total cost for hedging is going up.
Yes, sir.
So why should you enter into a future contract? The answer is very simple. Forward contract or money market hedge, these are all bilateral contract between you and the bank. So there is a chance, see, you are entering into a contract, one year contract, which will be, after 1 year. 1 year, a bank can also become bankrupt. So there is basically there is a counterparty risk. But in case of a future contract, since it's an exchange traded contract, so exchange is giving counterparty guarantee to both buyer and seller. Not only that, it is much more liquid. What do you mean by it is much more liquid? At any point of time, once you enter into a forward contract, suppose the exchange rate is moving in your favor, you want to close it. You cannot. Because suppose two of us enter into a contract. Suppose you buy one future contract from me, one forward contract from me. So if you want to close the contract, you have to come to me or you have to find somebody who is ready to buy from you. However, if it is a future contract, even if there is only one buyer and one seller, suppose you are the buyer, I am the seller. But since it is an exchange traded contract, there is a ready-made market. At any point of time, you can go to the market and close the contract. I repeat, at any point of time, you can go to the market and close the contract. What does it mean? That means it is very liquid. Since it is very liquid, that is why, first of all, it is secured. Second, it is much more liquid than the forward contract. So basically, when it is more profitable, naturally it is more costly. In the finance market, I told you earlier also, that is risk and return, these two words always go together. So when you are buying a future contract, since it is more liquid, more profitable, so it is more expensive. So expensive in two ways. First of all, there are brokerages, then there are mark to market. Your money is mark to there is margin money. Margin money means your money is blocked with the exchange for a period of 1 year. So there is an implicit interest cost. So which otherwise you are, if it is your own money, you are losing that cost, interest cost. If you borrow the money, you have to pay the interest cost. So these are the things of future contract, and of course it is settled in cash. Cash settlement is not an issue because you get the same amount. Okay. Any question on future contract? Any question on future contract?
No, sir.
So what is our next one? Option. So future is done. Future contract is done. So then we'll go to foreign currency option. Okay, so you're left with basically 3 foreign currency option. So Interglobe Aviation Limited has a payable of 500 million euro. What should it do? What kind of option it should enter into? Any idea?
Sir, call.
So if you, first of all, what is a call option? I told you buyer of a call option has the right to buy, but it does not have the obligation to buy. Okay, for that it has to pay a premium. So here the strike price is given. So if Indigo buys a call option, then it has the right to buy 74.51 euro at a price of 74.50. So 500 million euro at a price of 500 into 74.50 rupees. It has the right, not the obligation. So in case of a forward and future contract, you have the right as well as obligation. So if you enter into a forward contract or future contract at 74.50, that means after 1 year, irrespective of the price, you have to buy at, say for example, forward contract 74.50. So if you enter into a contract like this, you have to pay 74.50. So whether the price is more or the price is less. In case of an option, you have the right but do not have the obligation. So you can, if the price is more than 74.50, so you exercise your right and you can buy at 74.50. However, if the price is less than 74.50, then you have the right, not the obligation. So you may allow the contract to expire. Okay, so you do not buy from him, you can buy it from the market at a lower price. So this way, option has an advantage over forward and future, where you have the right but do not have the obligation. So, but condition is you have to pay a premium. When you buy an option, you have to pay a premium. So this premium payment is a sunk cost. So in the future, whether you exercise your right or not is immaterial, but the premium which you paid, that you cannot recover. Okay, so if you buy what is an option contract? So IGL can buy a call option at a strike price of 74.50 at a premium of 1.5 per contract. So total premium paid is 500 into 1.5, that is 750 million rupees. That means the total premium payable is 750 million rupees. However, the biggest advantage of buying a call option is that IGL will have the right to buy 500 million at an exchange rate of 74.50, but it will not have any obligation to buy at 74.50. Any question? Any question?
No, sir.
What are the advantages of option? First of all, you have an advantage, you have the right, you don't have the obligation. So in case of a forward and future, you have the right as well as obligation. So this is the biggest advantage of option. So I'll tell you the other advantages and disadvantages, but before that, can you use put option? Of course you can use put option. What kind of put option? So here you see a put option at a strike price of Euro 1 is at 72.50 is trading at a premium of 0.8. So if you buy a put option, you have the right to sell, but here you don't sell, you have to buy. So you write a put option. I repeat, you can also write a put option at a price of 72.50. There you receive a premium of 0.8. 0.8 into 500, that is 400 million. But when you write a 400 million rupees, but when you write a put option, you bear the risk because you have the obligation to buy. So suppose the price is more than 72.5, that is, suppose the price is 76. So the buyer of a put option, he has the right to sell at 72.5, but he doesn't have the obligation to sell. Okay, if the market price is more, he will not sell it to you. He will not exercise his right. He will sell it in the market. So as a result, if he does not exercise his right, you have to buy it because ultimately you need to pay 500 million to Interglobe, to Airbus. So you have to buy 500 million euro from the market, and the market price is now 76. I repeat, suppose you write a put option at a price of 72.5. So when you write, immediately you receive a premium of 0.8 into 500, that is 400 million rupees. That is your, so irrespective of the person exercising his right, buyer exercising his right or not, you receive 400 million rupees. Now next is, after 1 year, if the price is more than 72.5, buyer is not going to exercise his right because he has the right to sell. He can sell it in the market at a higher price. Now, if he does not exercise his right, then what is happening? You have to buy 500 million euro at the prevailing market price. If the market price is 76, you have to buy at 76. So basically, your risk is not eliminated. So when you write a put option, your risk is not eliminated. Only thing here is you are receiving a premium of 400 million rupees. Okay. So buying a call option, your risk is totally eliminated by paying a premium because you have the right at 74.5. However, if the price is less, you do not exercise your right, you can buy it at a lower price. But put option, it is just opposite. So here you don't pay a higher price, but if the price is less, you can buy at a lower price. Put option, if it is a higher price, you have to buy at higher price. And on the other hand, if the price is low, you do not have the right to buy at a lower price. The minimum price which you get is 72.5. If the price is less than this, you do not get that advantage because the person will exercise his right. On the other hand, if the price is more, you have to buy at a higher price because that person is not going to exercise his right. So put option, you do not eliminate your risk, but you receive a premium. A portion of your loss can be compensated with the help of the premium. And of course, you can also make a profit with the premium. Call option, your loss is known. That is the maximum amount of losses your premium paid. Put option, your maximum amount of profit is also known. That is your premium received. Question, confusion? Anybody?
No, sir. Sir, like out of the, yes, sir.
Just 1 minute. This is also discussed. IGL can sell a put option at a strike price of Euro 1 is equal to 72.5 and receive a premium of 400 million rupees. However, by selling a put option, IGL cannot hedge its risk. Therefore, selling a put option will not be a useful tool to hedge the risk in this case. Yeah, tell me.
Sir, out of forward, future and options, which is more prevalent?
We have a last question. So why only forward, future and option? Yeah, other techniques are also there. Last question is on that.
Okay.
So when this case which we are doing, our last question is of the hedging alternatives analyzed, how would you recommend to Interglobe Aviation Limited and why? So wait, we'll definitely discuss. Acha, next class, just remind me, we'll start with the advantages of option contract over other methods, that is forward, futures, etc. One advantage we have discussed, but there are other advantages of option contract. Okay.
Yes, sir.
So any other question?
So no question, but I just wanted to remind, like in the last class you have mentioned like you'll be discussing about the assignment, like the group formation and the cases.
I yet to decide. Hopefully by end of this week we'll get, because I am also in two minds, because I am also keeping in touch with my daily counterparts, what to do, because there are certain other things also. Please don't, I will not say you remind me by end of this week, but next week definitely, because I'll have to give you next week, because after that, though my next week my classes will be over, but you will have about a month to finish off the trimester. So I'll make sure that you submit the assignments on time. So next week you remind, if I don't give it within that. Okay?
Yes. Thank you.
Sir, I had a small doubt. So, like, how many groups can be there and how many people per group can be there? If you can tell that.
If it is not yet decided whether it will be a group assignment. If it is a group assignment, maximum 4 people per group.
Okay.
See, if there are 55 students,
There's 57 are there. 57 students.
57 is not divisible by 4.
Yes.
So 1 or 2 group may have more than 4 member or less than 4 member. Okay. Make sense?
Okay, sir.
Okay. Okay, then bye.
Thank you, sir.
Thank you.